Good morning, everyone, or good afternoon if you're on the East Coast. Thanks for joining us. What we're going to do is we're going to jump right into things, just to be respectful of people who turned up on time. But I'm Timothy Wong from Spark Plus. For those of you who are not familiar with Spark Plus, we help Australian small caps with their corporate strategy and investor outreach here in Singapore and Hong Kong. We also work with Asian funds and family offices to help identify investment opportunities. And one of those opportunities is uranium. That's what we're talking about today. There was quite a bit of interest for this webinar, just given where the spot price is at. So I'm delighted to be joined by Cyprus, our analyst, and Bruce Lane, the CEO and Executive Director of GTI Energy. They listed on the ASX and the OTC. But really, some of the topics we hope to cover today include what are the macro factors affecting uranium today, but also historically, and what I'm really looking forward to hearing from sort of Bruce and Cyprus about the industries, whether they think it's a cyclical boom or they believe it's a structural shift in the industry and the demand and supply economics. So, of course, we also want to apply some of the knowledge that we get out of today. So at the end, we'll be asking both our experts how they invest and how we can implement strategies in our own portfolio, in our own approach, right? I'm just going to quickly share my screen. I've got some visual aids for today. I promise I won't leave them up all the way. It is meant to be as interactive as possible webinar. But I'd be remiss if I didn't quickly go through some of the usual disclaimers. Of course, all advice is general in nature, hasn't been tailored to investment risks, appetite, and there will be forward-looking statements in today's webinar. But now, before we get too lost in the weeds, I think it's a good time to get to know our speakers for today, maybe starting with Bruce, and then we'll go to Cyprus after.
Thanks, Tim. Hello, everyone. So my name is Bruce Lane. I'm the Executive Director and CEO of GTI Energy Limited. GTI is focused solely on exploration and development of uranium projects, and in particular, we've got a portfolio of projects in Wyoming and their in situ recovery projects. So we hope to be able to mine those using the in situ recovery or in situ leach technology, and I can spend hours talking about that, but just to make sure that that's a point of difference for us, and just to remind people that the US is the largest buyer of uranium on the planet, which is what the back doorstep of the nuclear power utilities. The US used to be the largest producer of uranium back at one point and was in the world and was producing over 40 million pounds a year. In the 80s, it currently produces next to nothing, which kind of captures what we think the opportunity is for our company within the broad macro thematic around what's happening with uranium globally. So look, I've been involved in uranium exploration and development projects in one way or another since, well, it's really been in excess of 20 years now. I came back to it in 2018 when we could see that the climate narrative was driving a need to change the energy mix, the electricity supply mix, and nuclear would come back into favour. And it has done very, very strongly. We're going to talk about some of those influences today. So thanks for taking the time to log on, and hopefully we can help to illuminate a few topics webinar, and please reach out with questions, obviously either during the webinar or afterwards. And thanks to the guys at Spark for setting this up and allowing me a platform to talk about my hobby.
Very good.
Great. Thanks, Bruce. Thanks, Tim, for hosting the call. I'm Cyprus. I'm an analyst with Spark Plus. As Tim had mentioned earlier, we cover the Australian small caps and bring them into Asia to our network of investors, of family offices and hedge funds. So I'm an analyst that covers the Aussie small cap space, and I've been with Spark Plus for 4 years now.
Excellent. Well, thanks for those introductions, gents. So let's jump into it, shall we? I think so. There we go. Uranium's obviously had a really good run in January. I think it's up 16.5%. But if we look at it year on year, the spot price is currently sitting at US $106 per pound, right? Over 100% increase in the last 12 months. That's outstrip returns from pretty much every other market. Bruce and Cyprus, can you speak just briefly on the nature of the uranium market? From what I understand, it's quite an opaque market. So what drives, or what's driving the spot price today?
Yeah, look, I'll jump in here. I think so. I think the first thing is the spot price did hit 106. It's pulled back to around, I think it's around 100 today, depending on what you call whether the bid-ask spread is what the price is, but it's somewhere in that $100 range. The price generally contracts, comes down at the end of the month. There's some players in the market, particularly in the spot market, traders who receive deliveries from producers, particularly Uzbekistan and some from BHP. They're incentivized to tap the price down at the end of the month because that determines the price they buy the next month's uranium at. So there's an arbitrage opportunity for them. So it does get manipulated quite a bit. It's quite volatile, spot price. And it only represents now, particularly recently, a very small proportion of what's actually traded and what's actually purchased and sold on the market. But the market has moved back to the way it used to be a couple of decades ago, where it's really a long-term contracted market, and the spot market was always there, but it was a small player, and it was easily manipulated. And as you can see, if you track the price, it is quite volatile, particularly at the end of each month. So just on the market in general, I mean, we know that when supply is scarce and there are issues and concerns with the utilities around security of supply, they obviously look to lock in long-term supply. When there was a lot of material of mobile inventory available above ground, they were less concerned. I think I don't know whether this is the point, Tim, where we talk about the history, but I think it's really worthwhile if you want to understand the fundamentals of the market and where we are, it's really important to understand what the history of the market is. Cyprus has got anything to add to that? I'm happy to talk about the history in a bit more detail.
Yeah, I think like what you've mentioned, Bruce, and there's a lot of players buying on the market and selling in long-term contracts, and I think it's also because there's a depletion of the mobile inventories after several years of underinvestment in the mining of uranium, even in the processing part, the conversion, the enrichment, and especially in the West, where we practically didn't see any new mines or new processing facilities set up over the past 10 years. So I think now uranium prices are only recovering to the point where producers can make money out from primary production rather than supplying their customers by buying on spot market to meet their contraction needs.
Yeah, I think it's worth reflecting on the history in the marketplace, just to understand what's driven some of those things that Cyprus has talked about. If as I said, if you go back to the 80s, the US was producing over 40 million pounds a year at its peak, maybe 44 million pounds a year. And then what happened when the Berlin Wall came down and the East and the West decided that they weren't going to engage in cold or hot war anymore, decided it was in the world's best interest that they enter an arrangement with the Soviet bloc countries to take nuclear weapons, surplus, what they now considered surplus nuclear weapons, and downblend them to nuclear fuel. And that was a program that went on for over 20 years. And it effectively meant that uranium was available to utilities in the US at a fraction of its primary mine production price. So call it, say, $5 a pound, although please don't hold me to that number. So nuclear power generators really had a long-term, very, very cheap supply on their doorstep. And at the same time, the US government removed the subsidies for the uranium production, conversion, enrichment, for the fuel, the nuclear fuel supply chain. So the industry in the US was a fair assured and wiped out the domestic uranium industry. And remembering that the US was the largest and still is the largest buyer of uranium on the planet, still the largest producer of nuclear power. So it's a kind of interesting decision, particularly, I think it was brought to light. There was a Section 232 report presented by the US Commerce Department in 2019 that really spoke to the fact that this was an issue going forward. And this was well before the Ukrainian conflict with Russia, which has led to a return to those days when the Berlin Wall was up, the bifurcation of the uranium market. And that's going to be enshrined into law in the US shortly. It's not a matter of if, it's just a matter of when. Is it going to be, weeks or maybe a couple of months before that gets passed and signed off by the president in the US? So we've ended up in a situation with the US being the largest supplier, going from the largest supplier to the largest buyer. Imagine if that was the case in oil. Nuclear power is 20% of the US baseload energy, and it's obviously used for firming the entire network because it's has such a good uptime. Their green energy, so it's vital. And obviously, I've got a very US focused kind of a view of all of this because that's where our projects are, and we believe that was all of that meant it was a great place to be in terms of exploring for and developing uranium projects. And I think that's been borne out in spades and much more dramatically than we ever believed it would be. But that bifurcation also has an impact on the global marketplace because you've now got Kazakhstan, the world's largest uranium supplier, already was very aligned with Russia, and shares a border with China, and now is also very, very strongly aligned to China. It really looks like going forward because in Kazakhstan in general, aside from its joint ventures, which it already has with the likes of Cameco, that production is really now looks like it's all going to go to Russia and to China, or the majority of it. So we've got a real bifurcation in the market here. We've got significant challenges that weren't there before, and the above ground mobile inventory that used to feed that spot market, it's not there anymore. It's either been sequestered into vehicles like Sput, or it's been purchased by China for their massive build program going forward. You've got France out there looking for more product because they can't get it out of Niger anymore, and they've decided to run all of their nuclear plants at full capacity and build more plants. I could go on. The Japanese, they turned off reactors and were selling inventory. Now they're turning them back on and restocking. So all of those factors have led to that above ground inventory disappearing. The other part of it is the cost of money, because to run the carry trade for the traders, they had freely available uranium and cheap money, and they could make really good money on the spot market. Now they don't have access to cheap money in the same way, not to the same extent anyway, and they're really struggling to actually find inventory. And all of their customers, the utilities, are now looking to buy on long-term contracts rather than spot. Cheap, but it's not. So so that's kind of those are all fundamental factors driving the demand supply scenario, and there are many, many more, and I really could rattle on for hours. Gives us a flavor of of the major change and why the market is so different now, and why we believe structurally, even without the growth and reactor numbers that have been projected and going forward, the market is in imbalance. And I think we've probably got more to say on that.
Yeah, no, I exactly. I think, Bruce, like what you were saying, the COP28 countries, I think 22 of them have committed to increasing the nuclear energy in their power mix. And I think power mix is something it's really interesting and worth talking about here. Obviously, there's been a lot of talk last year and maybe the year before that as well about renewable energies and how they play in the power mix, right? How does how does nuclear energy play with renewables? You know, you talked about a concept of firming before, or base load. You know, like how do those two things play together? Are they mutually exclusive?
Yeah, I guess the thing with the renewables, if there's abundant wind and solar energy, and you can keep the cost of energy down, then they could be a viable and can be a viable source of energy in some locations going forward. I mean, Australia more so than Germany, I would suggest, but that's kind of interesting to see how that's played out. But because of the intermittency of supply, because the sun doesn't shine all day and for clouds and nighttime, and the wind sometimes it doesn't blow for days, then batteries are not really a practical alternative. There's a lot talked about, but batteries are fine short term, very short term. But you're talking sometimes days and days when the wind doesn't blow. So how do you deal with that? And the way that it's been dealt with in the past is, natural gas production of electricity has kind of filled that gap between where coal's being depleted, or they're pulling back on coal. So natural gas has been the way to firm the network and deal with that intermittency of supply. And the networks are obviously a very complex beast. And running a network, particularly over a large integrated network over a place the size of, say, Australia or China or the US, very, very challenging, particularly when you're putting these intermittent sources of energy and feeding it back into the network. So nuclear has, in the US's case, provided that stability, so that the consumer just doesn't know the difference between a windy day and a still day, or nighttime and bright sunshine at midday. So that firming support in the network, you can't really do renewables beyond a certain point. Like, most networks will cope with a small amount of renewables, but once you push it, the amount of renewables past a certain threshold point, it starts to generate real issues in the network because of the intermittency. And you still need the firming capacity. You still need power at night. You still need it in the afternoon when the sun goes down and the wind stops blowing, or whatever it is. So, that's where, if you look at all of the firming options, nuclear is the cleanest. And, despite what I think some politicians would purport and assert, it is the cheapest. So particularly if you're not going to go with natural gas or coal, you really have few alternatives. So I think, it's the more electricity the world needs, and it is going to need more. There's no projection anywhere that I've seen where the demand globally for electricity is going to go down. Now, in certain markets, it can go down a little bit. In the mature markets, if you make it really expensive, people will stop turning the lights on and what have you. But if you ask them all to start charging their cars, that kind of offsets that. So the electrification of everything, and I think, Cyprus, you had some comments about this, I think, is driving demand for electricity globally. And as more people come out of poverty, they use electricity. It's just the way the world works. And
I don't know about that, Bruce. I think I've seen people who don't have a job and don't have a house, but have an iPhone that they charge on the regular.
Yeah,
So
well, no,
they don't even need to be, what I mean?
no,
Yeah.
that's right. I think it's demand and requirement for electricity is driven by lots and lots of things, but it is only going one way. And
Yes.
and I think we are struggling to keep up with that in any case. And so I think, one of the points of discussion we chatted about earlier was, if nuclear just maintains its share of the pie in terms of electricity requirement going forward, it's going to grow quite significantly anyway, let alone all of these projected, growth ambitions that were, you touched on it before, Tim, 22 countries saying they want to triple their nuclear power production. And then you've got another 30 countries saying, oh, we want to start producing electricity using nuclear. And all of the forward scenario adds small modular reactors, which I think the US, the Department of Energy conducted a study that said that there were, close to 1,000 retiring coal-fired power plants that could be given a heart transplant with a small modular reactor. Poles and wires are all there. Most of the infrastructure's there. There's even people there that can be retrained. So it does all make sense. But we don't really focus on that. What we're focused on is the current requirement for nuclear power plants to buy uranium. And that is they need around 200 million pounds of uranium a year. Primary mine production is only about 150 million pounds. There's the gap, 50 million pounds. That's the annual requirement for the US every year. So, the industry can't even supply that. They're not even coming, they're sort of 25% below that now, let alone the growth scenarios. So it's quite a, and because the industry's been so sick for so long, the cost of the uranium price has been below the marginal cost of production, which is why all these mines have shut down. That getting back to full production is going to take some time, and price is not going to all of a sudden collapse because one mine comes on. It's just that doesn't look very likely to me at all. And I think there are plenty of smarter people than me telling that story out in the industry, and I think it's a very compelling story.
Yeah, Bruce, I think it's a good point that you touch on, just maintaining the nuclear share of the electricity generation market is enough to bring it, a few times ahead, because in general, as civilization progress, we rely more on electricity. How many devices did we have in our home 20 years ago, versus 10 years ago versus now? I was just, doing some renovation work at my house, and the contractor is starting to ask me, do you want to, put smart switches in your house right now? It's not something that we will be thinking of in the past, right? Even, I just bought a robo vacuum cleaner. In the past, we would just sweep our house with a broom and a stick. Now there's a robot doing it. So I think, as we progress, we want a better quality of life. We want a better standard of living. And we rely on robots, rely on machines that use up electricity. And these machines, or our smart home, smart nation, Internet of Things, they will all need electricity running 24/7. So when you talk about nuclear energy providing that base load or firming, consumption in electricity fluctuates throughout the day, right? We don't stay at home the whole time, so we only come home off work before we want to go to bed. We turn on the AC, and that's where a lot of different living habits actually give spike to our electricity consumption. So I think with nuclear, it's a good way to provide a base load throughout the whole day, whereas the renewables, they can come in when there's a certain spike in consumption. They can supply that spike, and at the end of the day, we have no idea. We can't control the weather. We can't control the environment. So there's a limit to how much the renewables can power our day-to-day average usage. So I think in the past 30 years, electricity consumption has increased at a rough, I would say 3% CAGR. And that equates to roughly 23,000 terawatts hours of electricity in 2021. So now we've been talking about electrification of the world. We want to replace our whole internal combustion engine fleet into EVs, into electric vehicles, and that itself, don't quote me on this. It takes roughly 50 million barrels of oil equivalent per day to power our vehicles, our transportation sector. So if I were to convert all of those into electric vehicles, let's say we account for the efficiency, we account for the weight difference of those vehicles, it would take us 10,000 terawatt hours of electricity. So that's already half of our global consumption. So and we still talk about AI. AI is gonna use up 100 terawatts hours as well.
Hey Cyprus, this you're on to what I think is you know, it's like gravity. You can't escape it. You know, we have never been more dependent on electricity, and everything that is occurring at the arena is driving us into more dependency on electricity. You guys in Singapore don't have too many power outages, but we had one. There was one or two here in Australia, short-term things, and localized. But when the power goes out, it's a big problem. It used to be a bit of a nuisance 20 years ago, and believe me, I mean, I grew up on a farm in the bottom of the South Island in New Zealand, and if it snowed, we'd lose the power, and okay, we'd find a way to heat ourselves and feed for a day or two. It didn't kill us. But here now in the urban environment, you lose electricity, you're in a world of pain. Everybody's in big trouble. And how does it make sense? How does it make sense? And sorry, this is my soapbox, so I'll be brief. But how does it make sense when we are ever more dependent to start relying more on unreliable, intermittent resources? And I think the chickens, if they haven't come home to roost already at the political level, they will. There's no way. You cannot deny gravity. So nuclear it's got the smallest footprint on the planet. It has the lowest emissions and the highest reliability and the best long-term safety record of any supply of energy. So that's a reality. That's a physics question. And so I think that nuclear will do more than just retain its share going forward. It will grow and prosper and become the power supply, the electricity supply of choice, and it will get used for industrial heat, because industrial carbon than electricity supply and other generating sources. So there are massive opportunities for nuclear, and I think we're seeing that coming through now. Kind of wrap up on all that. I think your average person is, particularly in the Western developed world, we have such a large amount of information available to us now, and people do consume a lot broader source of media, that the education piece is happening at the consumer level, if you like, at the retail voter and retail investor level. And governments really need to stay in front of that, because popular and people's logical brains are taking over. And I think they are challenging the policy stance of a lot of governments at the moment. We're seeing that worldwide. And whether it be the farmers to lose today, or the Belgian farmers, the French farmers, the German farmers, it's all part of the same story. And so I think we'll see a more rational set of policy settings going forward, and we're going to see a much stronger demand for nuclear power and a much stronger demand for uranium. And I'm very convinced of that.
Yeah. Yeah, excellent. Thanks for sharing, gents. I think now, obviously, we spent a bit of time on the demand side of things. Let's turn our focus to the supply side of the equation. Are supply chains equipped to deal with this increase in demand? Given the US ban on Russian uranium and nuclear fuel is looking like an eventuality, what does historical look like, and how is that changing?
Yeah, look, I think this is where it starts to get pretty interesting. I think I touched on before, there's about 200 million pounds a year of primary demand from nuclear power reactors. Now, there's some financial players in there who've been buying pounds, whether they be traders or the likes of SPUT, the trust, which sequesters pounds. So it's not a hard and fast number, but let's call it 200 for the ease of the maths. And then the annual primary mine supply is I don't think it is actually quite 150 million pounds. I think it's less than that, but it's around that mark. So that's, if you take any mobile inventory, above ground inventory out of the picture, and just said all you've got is mine supply and all you've got is reactor demand, million pounds short based on today's requirements. And so there's a gap, and the biggest suppliers in the world, Kazatomprom out of Kazakhstan and Cameco. Kazatomprom have a conference call, I think on the 1st, in a day or two, where they're going to bit more about why they're not going to meet their production targets going forward, so they're going to fall short. And remembering that the likes of Orano and Cameco have joint ventures with Kazatomprom for Kazakh projects. So that's going to affect their ability also to supply to their customers out of Kazakhstan. And on top of that, we think that Cameco, they've got an investment in the 7th or 8th Eastern time of February, where they'll talk about their production numbers, what they've achieved over the last period, and what they're projecting going forward. And we think that there's probably quite possibly some challenges in there for them as well. So we see even the current suppliers at the moment are struggling to meet their numbers to produce that number of pounds, and that's without thinking about this bifurcation of the market issue and the Russian nuclear fuel. So there is a really significant, strategically important market imbalance here. It is structural, and it's not easy to turn a mine on, even if it's been idled for a significant period of time. It will take, years to get them back into production. The uranium price is only just within the last 6 months, come back to an incentive price that would actually incentivize those producers to start producing again. If you look at UEC, the largest uranium company in America, they've got a lot of assets around us in Wyoming, and they've said that turn their ISR plant on at Willow Creek in August this year. At the end of last year, in the last quarter, they said, well, what we need to see is at least one quarter where the uranium spot price is above $65. So you only have to go back, 6 months, and the uranium price wasn't even at that level. It's ramped very quickly in the last 6 months. It's gone up by 50%, and that's meant we've gone through that and into that incentive. But these capital investment decisions don't get made based on short term, particularly new mines. Restarts are a bit different. The capex is generally much more modest and the timeframes are shorter. But to build a new mine, you don't do it based on, the spot price looks healthy this month, I think I'll build a mine. It needs to be back in contracts. No one's going to risk, you look at NextGen in Canada, that thing's billions of dollars to build. So, and it's going to take 10 years from now, probably. I mean, don't quote me on the time, but it's a long-term, commitment. So we need sustained prices over an extended period of time to bring on new mines, new conversion, new enrichment, new fabrication, capex investment. These guys will not be running around flapping their wings saying, the price is good and I think I need to build something. They need major commitments from governments. They need major commitments from utilities, from their customers. And they need a long period of time to staff these things up, get the permitting all done. So the supply response, and particularly for an industry that's been on its knees for so long. It's not like the gold mining industry where there's always someone digging that stuff up anywhere in the world. You got to remember that the entire uranium industry in the US switched off, left their pounds in the ground and supplied their contracts to their customer commitments out of the spot market. So they need this long extended period. And so I just think it is going to take a long time before enough supply comes on to dampen the price.
Yeah, even on the market, if you look at existing projects that are said to be upcoming, most of them are in the range of 5 to 10 million pounds per annum, right? We don't see any significant producer to be that could close that 50 million pounds of deficit. So even you see they are looking to restart only now when prices are, I think Bruce, you mentioned above 65. So many of the other players outside might have a cost curve that's way higher than 65, and they are not ready to come on market. And with with the whole uranium and nuclear, I guess, environmentalist issue, a lot of countries actually have banned uranium mining or extraction in the past, and has only recently allowed that in their country. So these are the areas where we didn't see any exploration done or discoveries made in the past 10 years. Right now, everyone has awakened to the fact that we need to rely on nuclear energy. They leave the ban and they allow people to go and explore, but like you mentioned, it would take a long time for them to discover a deposit and prove it to be economical and work it through to production. That could be a 10, 15 years sort of pathway. So we won't be able to see any immediate supply to cover that deficit in the next, I would say, 1 or 2 years.
Look, yeah, you're right, Cyprus. I think it's even more extreme than that. I think if you look at where there's been no significant exploration conducted for a lot longer than 10 years. I mean, we're using historical data that was created by oil companies back in the 70s. And so there was, once those exploration incentives and industry incentives fell away in the US, at the end, during the 80s, at the end of the 80s, there was no since, kind of 1990. So you're talking more like 30 years. And yes, there was a little spike, back just prior to Fukushima, and the uranium price went up, but it went up for about a year. And, by the time people get a permit, get the drill rigs organized, get their funding in place, and they go drill and get the results, that's it. It's over. Already the price is too low. So that's what happened back in that spike. And I think that's why a lot of investors are conscious of that, and they look at what's happened with lithium, and they've seen it crash period of time from these really strong prices. And you got to remember with lithium that lithium's demand is all about a future market. It's about what's going to happen in 2, 3, 4, 5, 10 years. If all these policy settings stay the same, you need a heck of a lot more lithium. And so I think there's a couple of things here. So that's going to be a lumpy supply demand scenario. It's not going to be a straight line to all of a sudden everyone driving an EV, and how many people are actually going to. So I think it's a completely different market. This is market, we've got an embedded reactor fleet that's supplying critical electricity into an environment where we want lower emissions, and we critically need network firming and support. So that's not going away. So the demand scenario, today's demand, that's not going away. So completely different. But I think that a year of a spike in price is not going to reboot an industry. So it's 30 years. The industry has been in the so what and Fukushima just made it worse. And that, and so what we're doing is trying to reverse that trend. And as you say, some of the timelines for, if you think about the first exploration hole through to producing uranium, easily 10 years most places. Where we are in Wyoming, we think it can happen faster because it's a self-sanctioning state. In the US, you don't have to go to the federal government for approvals. And a lot of the exploration's already been conducted. We've picked up old exploration, and we know the path to permitting. There's mines that look just like ours within 10 or 15 miles away. We're in the similar, almost cases. So we think it can happen faster. But as you said, they're not huge mines. And neighbours, UEC, we talked about before, 2.5 million pounds a year of permitted production at Willow Creek. Time to ramp up to that. Next to us, 10, 15 miles away in the Powder River Basin, Cameco's got the largest permitted in situ recovery facility in America. It's 5.5 million pounds. So it's not insignificant. I mean, if you think about that, that's a, if you can generate, $50 free cash per pound, it's a pretty good project when their all-in sustaining cost will be around, certainly be sub $50, I would imagine. At $100 uranium price, these things make a heck of a lot of money. But it's still only 5.5 million pounds for that one plant. If they can get enough of a bore field development out there to supply it to its maximum capacity, which can only happen over a period of time. You just can't turn it all on one day. You have to prime the bore fields with lixiviant, and then they build to a capacity, and then you've got to keep doing mine development, putting out more bore field to get these things to produce. So, yeah, I think everything you say, I absolutely 100% agree with. I just think it's even more dramatic, I guess, and I believe that is going to support the price scenario, because the demand is there, the desire to long-term contract is there, but no supply can offer the pounds that are being looked for. And so they're going to have to make a commitment, the utilities, I believe, to the producer space, to the converters and the enrichments, and lock in contracts ahead of time that the pounds are available. Where the real opportunity is. Strong incentive pricing over a long period of time will support the final investment decision on mines and the development of future mines. And that's now where the utilities, I believe, are catching up to that story.
I suppose similar to how, sort of BMW and some of the OEM car makers have gotten involved in the sourcing of their lithium with prepay or, forward offtake contracts is sort of what you suspect might happen in the industry. It sounds like, almost the perfect storm of geopolitics, of macro demand and supply factors that have shifted, and it seems like the consensus is that it is a structural shift. Commodities are cyclical, yes, but it is a structural shift in the uranium industry, sort of a long time coming even from World War II days. How quickly can the industry shift to meet all the increased demand that we talked about? I was reading somewhere that the average time to production for a mine, from discovery to production, is 13 years, including all the funding, all the RTOs, all the number of times it changes hands, and major shareholders finally getting minerals out of the ground can sometimes take 13 years. What about the uranium supply chain side of things? Conversion, enrichment, fabrication. Can you talk to us just briefly through that so that we get an understanding of what the industry looks like?
Yeah, I mean, you've obviously what the nuclear fuel or what the nuclear power plant uses is the fabricated rod with enriched uranium, with the enriched uranium-235. Every reactor, well, not every reactor, but there are lots of different reactor kinds: boiling water, pressurized water, for instance. And the reactor designs themselves, whether a Westinghouse or a Chinese, and sorry, I can't remember the name of the Haolong reactor, or a CANDU reactor from the Canadians, which is a different beast altogether and doesn't use the same fuel cycle. There's a complexity in the supply chain, right? So, for instance, Westinghouse was purchased by Brookfield and Cameco recently. And one of the reasons they did that is because the fuel fabrication capability of Westinghouse allowed them access to a much larger proportion of the global reactor fleet. For instance, the Ukraine reactors now are going to be supplied by Cameco Westinghouse. So the fuel fabrication piece at the end, reasonably complicated, quite diverse, and you don't have one kind of fuel rod being produced by 20 different companies. You have a few companies in a few jurisdictions, because remembering that uranium, for very good reason, and particularly the enrichment part of it, is a highly regulated business. So where it all starts from, though, is that the nuclear power plant, or the buyer at the nuclear power plant, he buys a fabrication service, which will deliver him fuel rods. He'll buy the enrichment service, which is units or SWU, and he'll buy a conversion service, which takes yellowcake and turns it into what's sometimes called natural uranium, or UF6, which is a gas, which then goes to enrich. And it's not until the buyer has contracted all of those phases, all of those separate processes, that they know exactly how much yellowcake they need to buy from the miner. And so, there are a number of different offices, particularly in the enrichment phase. It's much more efficient for the enricher, who's running generally speaking, a centrifuge, which takes the gas and spins it and separates out the 235 from the rest of the uranium isotopes. They to actually maximize their efficiency in enrichment, they want to run it at a certain speed to produce that product that then goes to fabrication. If they run it to their optimum, it produces more uranium goes into the tails as a byproduct, and therefore you need more uranium to go on the front end. And I think it's like squeezing lemons. If you're in a hurry, you leave a lot of lemon behind. If you've got all day to squeeze those lemons, just wring them right out. We're now in an environment, particularly with Western enrichers, where they do not have time, and they run their operation much more efficiently by leaving a lot more lemon juice behind. So that's where we're at, and that process from purchasing of the allocate through to converting it into the UF6 or the natural uranium, the gas, and then enriching it, and then fabricating it and delivering it to the utility, can take years. And I think it can be done, reasonably quickly, maybe easily within a couple of years. Say, I'm no expert in this field, but when the supply chain is under pressure and everybody's looking for Western conversion when there isn't much capacity, and Western uranium and enrichment, then it can take longer. And I think the utilities hold a certain amount of inventory to protect them from any shocks in the supply chain. So there are a number of years of inventory in the supply chain, and in Japan's case, I think they were holding 6 or 7 at one point, which they then subsequently started to sell down into the market after Fukushima. But it is a complex supply chain, and it is a major factor in terms of understanding what the demand for yellow cake will be. And what we're seeing at the moment is the centrifuges that are being run hard and fast. And so the long-term contracts for enrichment, now the likes of Urenco are stipulating a much higher tails assay than they would have been, say, 2 years ago when their centrifuges weren't very busy, or 4 years ago when they weren't very busy. Is that's having a major impact, maybe as much as 20% on the demand for yellow cake. So it's another driver in terms of the demand requirement for yellow cake. Sorry, maybe I got a bit off topic there, but that's for how that uranium supply chain works. It costs a couple of $1 billion to build a centrifuge. It's not something that these guys, once again, they're not going to do it without long-term committed contracts and agreements by government that the government is not going to change the rules and leave them with a stranded asset, because that's what happened back in the 1980s. The government changed the rules.
Yeah, definitely.
Yeah, and they stranded every industry's assets, got stranded. All that committed capital, all those people, all those jobs, they killed the industry. So the industry is now saying to government and the utilities, we're here for you, but, we need to be standing together at the altar and making some commitments here, because we're not going to put $2 billion of capital up on the back of a Russian uranium ban, and then you guys are going to change the rules in 2 years' time. So they need that kind of commitment, or the capacity is not going to be there. It's just too high a risk. And that I think is the general sentiment. And when we talk about structural changes in the industry, it's gone from being a seller or producer's graveyard to being the seller or producer's market. The seller or the producer has the power in the market, and they're starting to exercise that, as much as they possibly can before. They're not going to be coerced into making these commitments. They're not going to do them. Risk capital likes a bit of risk, but not that much risk, because they've seen what happened before in the uranium market, and the money wants the reassurance. And those messages are being transmitted through to the utilities and being transmitted through to government to say, look, if you want things to change, you're going to have to make some changes too. And that's why we're seeing the Department of Energy responding, all this political dialogue now that, 5-10 years ago, it was too high a risk in politics to support uranium and to support nuclear power. Now it's the opposite. Now it's a political opportunity. And I think Brandon Monroe from Bannerman, he did an interview with Crux Investor a day or two ago, and I think he articulated it really, really well. That if you're a politician now anywhere in the world, uranium and nuclear power has gone from being high risk on the downside to being a high opportunity on the upside, and that's as much as anything the structural shift in terms of sentiment and what will become reality in terms of policy settings, support, and alignment with industry and the customers. The nuclear power generator. I think there's an alignment now that wasn't there before, and there's real investment going into place and real policy changes that just weren't there before. And I think that, if you're an investor coming into the sector, I think that's where you get the encouragement from. That's where you get look, and read it. Like, there's an avalanche of news, positive news in the media about nuclear power, and you don't have to scratch too deep to find it.
Yeah, Bruce, I agree. I think one important point to point out as well is that, the enrichment facilities in the world is just concentrated in, I think, 5 countries: Russia, Canada, France. We have one in US, but it's not operating right now. And Russia kind of process 40% of the entire enrichment needs. So there's a real risk for the Western countries when we talk about bifurcation of the economy. So another thing that I want to point out is that a lot of these nuclear reactors, they don't change the fuel rod every day or once a month, like what we have in the lithium industry. They put in the fuel rods and let it burn for 1 year to 24 months before changing them out. So it's very typical for all these utilities company to actually sign a very 7 years and above sort of offtake with all these uranium upstream players. And we do see that makes the whole supply chain more vulnerable to any disruption, because any point in time when you delay, you risk not running your plant on schedule, you're not providing the electricity you need. So I think that itself adds on to the supply chain risk as well.
Yeah, and that has been dealing with that in the past, is to hold inventory, to hold stock at every part along that supply chain. And that's why when you look at the inventories at the moment, you might look of inventory above ground, and there is, but it's there for a reason. It's not available for sale. And if you look at, say, for instance, in the moment in the US, because a lot of the US nuclear power utilities, the buyers have been aware of the challenges, both from a logistics point of view of getting uranium out of Kazakhstan via, instead of via St. Petersburg, maybe via the Caspian Sea, or the Caspian route. So they've looked for more inventory, because I'm not sure if I'm going to be able to get it to the converter on time. And then, in addition to that, they've flexed up their contracts with these guys, with the Kazakhs, because they're good contracts. The uranium's cheap, new contract, and they've activated their flex provisions to pull forward, to maximize their take, and also, where possible, they've been pulling forward purchases because they know the ban's coming. So they want to get themselves organized to make sure that they don't run out. And so, there's a lot of things that have happened in the industry. As you said, it doesn't move fast, and these guys, they can look into that supply chain and make sure they've got all the shock absorbers in place. I think what perhaps they are only really starting to acknowledge is just how thin the market is for supply. And there's a bit of, it's like musical chairs, where the music, there's the sense that the music stops and there isn't a chair, and you can't get caught in that position. So there's been a move back to long-term contracting, which is a big part of managing that supply chain risk. You know,
Yeah.
there's been we're not back yet at replacement rate on the requirement. What the actual price on long-term contracts is a bit hard to determine because most of them are market referenced. And so if the spot price, you know, accelerates, some of them have ceilings, price ceilings in them. They certainly have price floors in them. Those floors and ceilings have both been going up. And I've heard anecdotally that there are some contracts out there without ceilings in them. So that if the spot price, then, you know, there's a reference to that in the contract. So, yeah, look, I think the more risk there is in the supply chain, the better that is from a pricing point of view for the miners and the producers in general, whether it be the enrichers, the converters, or whatever. Because you know, as you said, you can't let these power plants run out of fuel. They generally don't like doing that. So it all bodes well for the downstream.
I'm sure they don't. Yeah, no. Look, we had a couple of questions come in. I think it's an appropriate time to discuss the question from one way. And Chen, what we'll do is we'll sort of discuss your question in about 5 minutes or so. For those who have to log off when the hour turns, I do apologize, we've gone slightly over here. But what we'll make sure happens is that the recording is circulated to you. So we'll get to these questions. We'll talk about M&A, we'll talk about long-term pricing as well. But one way was asking, you know, could you explain how enrichment can move away from Russia, what the time frame would be, and who the likely players would be in this scenario? My first guess is, you know, the US, right? There's a lot of investment that's probably going into the sector, but also, you know, energy security is not just about having it onshore. This whole concept of friendshoring, or, you know, having it located in your friendly neighbors' jurisdictions. So maybe Cyprus and Bruce, you can chime in with your thoughts on that.
Yeah, well, look, I think, yeah, sorry, I think, you know, the likes of Urenco, who are, you know, a major player, if not the major player outside of those state-owned enterprises, you know, they clearly have the capacity to create more capacity and to invest in the industry. And you know, there's been discussions about that. I think they've invested in some upgrades, you know, maybe building facilities out by another 10-15%. But that's on the back of having contracts for that capacity, as I said before. So, you know, I think to make the step change to invest, to say, you know, round number, don't hold me to this, I'm not an expert in conversion or enrichment, but if you have to spend a couple of $1 billion on a new conversion or a new enrichment facility, then you know there's a lead time associated with that. There's a supply chain response for that. You know, centrifuges, Walmart or Costco or Sainsbury's, you know, waiting to be picked up off the shelf. And as I said, the financing decision on that, really there needs to be an order book built around that capacity, be backed with earnings. So to get all that done, there is obviously a gestation period. So I think, you know, the response, if you said it was a couple of years, I think that'd be fast. I don't think it will be that quick. But I don't know how well developed those conversations are. They may already be halfway towards filling an order book. But I think they need, as I said before, they need that legislative support. They need that government support to say that, you know, there's going to be some things put in place to make sure that those assets are protected before they make the final investment. There's a number of factors, and I think it is going to take time. And I think that's what one of the factors in holding up, you know, the industry generally is going to be that kind of debate and supply chain. That I think, you know, we can't turn all the mines on in you know, straight away anyway. So, you know, if you get the uranium out of the ground and you can't convert it, there's a bottleneck there. If you can't there, and if you can't fabricate it, there's a bottleneck there. So the whole industry sort of can only move at a certain speed because of the complexity of that supply chain, and because it's such a small number of players. And high barriers to entry, both capital and legislative. So, you know, it's very difficult to go and just put an ad in the paper and say, oh, will somebody convert uranium for me or enrich uranium for me? Well, obviously it doesn't happen like that. It's really going to probably grow around the existing players. So, you know, the short answer is, well, how many years, I don't know, but it's certainly a lot more than 2. You know, is it 4? Is it 5? I don't know. I mean, that's a question for Urenco and Convidine, if you like, and the likes to answer.
Yeah, fair enough. And Chen asked, you know, he's let me just put up his question here. He asked if the current spot price of $100 per pound has fully priced in the supply and demand deficit. And I mean, you know, I recognize it is a bit of a crystal ball question, but where do we see the price of uranium settling in the long term, say, you know, 1 to 3 years?
Yeah, look, if you look at the current price, and if you think about the inflation component 3 or 4 years down the track, how much does it cost for capital? How much does it cost for OPEX? You know, salaries, wages, fuel, all. Have you seen any FID decisions for brand new mines based on the current price? And you know, the answer is no. There's step out projects and there's incremental projects and those sorts of things, particularly where we are in the Great Divide Basin. The, you know, all-in sustaining cost is around that region, probably 40, and the capex is modest for building a plant. You know, if we were to build £1 million a year plant for a £10 million deposit, we think the capex is in the order of, you know, say $75 million, maybe up to 100 if it was in 3 or 4 years' time. So those decisions are easier. But if you've got to raise $1 billion and you're wanting to lock in some sort of security around that, then you know the price is not going to be $65. It's not going to be $75. It's much more likely to be above that $100 mark. Now, how far? That's the long-term price I'm talking about. I'm talking about the long-term contract price. Spot price can be anything, you know, because spot price is all about a trade on the day. Who's got pounds for sale and who needs them? And, you know, anecdotally, Kazatomprom were in the market buying spot pounds. Their trader was buying spot pounds recently, which is what drove the price beyond 100. They've got a contract to supply. They need pounds. Well, they're going to try and get it. If they've got a hole in their contract book, then they'll either get contract penalties or they'll certainly lose their reputational advantage if they can't supply those pounds. So they'll look to find a way to supply those pounds. So who knows what that price is? I don't know what spot buyer is going to be willing to pay. My gut is that we'll go higher from here. Where we haven't, I think, if Kazatomprom come out and make some statements about their ability going forward. Cameco does the same. They're the 2 largest producers in the world. The spot price could go quite a lot higher. But, you know, and when the spot price is high, everyone hangs on to their pounds. You know, like nobody considers to be, you know, kind of fungible, other than maybe the traders who are buying off contract and then trading into that market. And if they think the spot price has got a lot higher to go, maybe even they will start to hang on to their pounds longer. Who knows? But yeah, I'm not going to call a price on the upside on the spot price.
Yeah, fair enough.
And the long-term contract price, I think it has to be, you know, more in the region that 100 or even higher. But you know, they're once again very difficult to prognosticate about that.
I think, in my opinion, when we talk about the spot price, it's really a crystal ball. No one knows where it could go, and it can really be anything. But some benchmark that I personally use is I look at the other, you know, energy commodities like oil, coal, natural gas. At their high, when they are all facing the energy crisis, when Russia invaded Ukraine, oil actually went up, you know, to $130 per barrel. That is 5.2 times, you know, the average break-even price at that point of time. For coal, it went up to $400. That's 6.7 times the break-even price. natural gas, in US, it went up to 4 times the break-even price. In other parts of the world, it went even, higher, up to 12 times the break-even price. And when we talk about lithium, the recent, wave of bull, they hit 6.3 times the break-even price. So right now in the uranium industry, a lot of the new projects, people are quoting a break-even price of roughly $80 to $90 per pound. If I use the average of what all other energy commodities I've mentioned earlier, I get a 6 times, that's easily $480 per pound. So I do believe that in the short term, there's still more room to grow or more room to run for the uranium price. Yeah.
I think that's a useful analysis. It's, I mean, obviously every market has its own unique characteristics and foibles, and I think uranium has some fairly unique features to it. But that's a worthwhile analysis, and I think if you look at it, even looking at the valuation of the listed companies, we've seen the producer companies and the investment grade companies like Cameco, their prices raced off. The very late stage developers like Boss, their valuations are right up there, and there are plenty of analysts saying that they're overvalued. The price still seems to keep going up, and that's based on the current uranium price, not what we think it might be in the future. The explorers have started to catch a bit of fire this at the early part of this year, and we're an example. We have just short of 7.5 million pounds of defined resources. Now, if you go back to the last uranium period of a bit of enthusiasm, pounds in the ground were worth sort of $5 or $6 US, where we are at the moment. Our valuation is around, it hovers because there's no, our price is a bit of volatility in it, but it hovers around $1. And we're right on the doorstep of all of these major 7 permitted facilities in a state that has been mining ISR since the 70s and 80s, with customers who are desperate for local product. So we just think the valuation hasn't shown up yet in the explorers. I mean, a few of the really large guys like NextGen, they've done well because they're very mature as an exploration play. They've got very large assets, very high grades. But I think on general, the explorer cohort, that valuation hasn't turned up. And I think it's part of the same story that you're talking about there, Cyprus, that the market in general and the price of uranium hasn't caught up to the story. And a lot of, if you listen to whether it's Rick Rule or Sprott or whoever it is, I mean, you know that there's a cycle where the explorers come last in terms of the cycle of value accretion or appreciation, and they normally, they're highly leveraged normally, so the price does often get away. And so, but I think in terms of just where we are in the cycle of the whole market, it is early days yet for the hype and the enthusiasm, despite the fact that the price has gone from $20 a pound to $100. As you say, that is only just squeaking past the marginal cost of production. And that's not going to be enough of an incentive to create a supply response. And that's without thinking how slow the supply response is. I think that's my view anyway. I think it's a very long answer to that question about the spot price, but I think it is a very fun distance.
Yeah, no, I think it's reasonable. Got to qualify some of the assumptions that we're making here. Now, with commodities, a lot of times when the spot price hits, begins to run up, we begin to see some of the majors, switch on the M&A or activate the M&A departments. Can we share a little bit about some of the historical M&A activity that we've seen in uranium, and if that's something we can expect in the next sort of 1 or 3 years?
Yeah, look, M&A for the last few years has tended to be around, companies and individuals like UEC, for instance, picking up assets that are not premium assets in terms of the market validation or where we are. Uranium One was sold cheap by Rosatom or Rosatom to UEC. It wasn't sold at a premium in a booming market. It was sold as a divestment disposal in a soft market. And so there's been, and if you look at Boss's assets at Honeymoon, they were similarly acquired for a very modest price in an extremely long-term depressed market. So there has been quite a bit of M&A in the past. Certainly we've had explorers banding together in the Athabasca with 92E and Atha and can't remember the name of the other company, ISO. So they've banded together. We've seen a few consolidations, a couple in Africa. They're more kind of strategic consolidations for smaller players to bulk up and get the attention of the serious money going forward, get rated, get above that $100 million market cap or the $300 million market cap, and really bulk up because there's so few investment grade companies available out there to invest in. So there's been a bit of that going on. I think we are going to move into a phase where you've got producers with production assets who need to secure supply for long-term contracts. So if they want a long-term contract with a utility, some security around their ability to deliver into that contract. And it takes a long time. It's quite fraught sometimes to explore for and develop these assets, and there's no guarantees that they'll actually show up under the. Whereas if you buy the neighbor who's already done all that work and taken all the exploration risk, you've got a short track to actually having pounds on your books to back your production numbers going forward. So I think we're in the phase where we will start to see that. But bearing in mind where we are in Wyoming, Lost Creek, URNG's Lost Creek, which is about 10 or 15 miles away from us, they went back into full production during 2023. That's just recent, like 9 months ago. They are the only currently producing in Wyoming, and then you've got UEC going to switch theirs on in August. So they're only just getting over that hurdle where they're getting back into production, which is a big deal. It's a very strong focus for a company. It requires a lot of effort and focus. They obviously never forget that they need pounds to put through the mill, and they have always got an eye on that. They're actually aggressively pursuing acquisitions to build out the pounds in their books. That normally takes a little bit further into the process, into the cycle. And so some jurisdictions, every jurisdiction will be a bit different. If you look, I think if the Chinese and you need to support their reactor build program of up to 150 reactors, you're going out and buying uranium any way you can from anywhere in any way, shape or form, down to buying another uranium mine in Namibia, for instance. Joint venturing with someone like the Kazatomprom to get more pounds out of Kazakhstan or Mongolia, for instance. And if you look at Macron, when Niger blew up and him out of Niger, he was straight away onto Mongolia. He popped up to Kazakhstan, up to Almaty to see Kazatomprom. He's scouring the globe for uranium. Similarly, the Japanese and the Koreans. The Koreans put out an RFP last year, didn't get it filled. No one was interested in their shitty terms, their price, and their conditions. So, they've got a massive domestic nuclear power program, and they export nuclear power plants and build them in the likes of the UAE. So where do they get their uranium from? They haven't got any at home. I had a uranium project in Korea, back in the 2010s, and just unfortunately did that whole thing. But they need uranium, and they don't have any domestic suppliers at all. And the same with Japan and many other countries around the world. So they're all out there looking at programs. If they're going to triple their nuclear power or turn their reactors back on, where do they get the uranium from? France doesn't mine uranium at home. So where do they get it from? So we've got a lot of drivers around that supply stuff. Sorry, I rattled on and I lost track of the question. I'll pass it back to you guys.
I think in all commodities bull markets, I think M&A activities have seen to increase, right? Like let's just say, for example, we talk about the lithium sector. That's very relatable to most audience as well. Back in the second half of 2021 or the first half of 2022, I think we saw about 20 deals worth 4.2 billion that is transacted. These are M&As on companies or projects with resources, all right? So that number, that 20 deals itself is twice the number a year ago, and that 4.2 billion value, it's 9 times the value compared to a year ago. So, back to when Bruce said it's a cycle where we see this valuation trickle down from the producers to the explorers. During high margin environment, the producers, got super normal profits. They are cash up, and they are worried about how to. I wouldn't say they are worried about how to spend the cash, but they try to strategize of how they should, spend the cash between long-term growth and rewarding shareholders. So naturally, in terms of long-term growth, they have to prove up the resource. They have to make sure they have a secure supply in the long run. So the best way for producers is to look for existing resource out there. So we do think that M&A activities is bound to increase this year within the uranium space, and we see the recent 2 acquisition. I think it's by Boss Energy acquiring 30% stake in Alta Mesa for $70 million. That's roughly $12 per pound of in terms of the resource that Alta Mesa has. And recent, I think it's ISO Energy acquired consolidated uranium as well for roughly $650 million. That's equates to roughly $13.5 per pound of reserve. So I do think that where the explorers, most of the explorers are sitting right now, is still below that $10 per pound. We would see some value accretion for all these explorers, and eventually when they prove up their resource, they might be a potential M&A target for the bigger players.
Yeah, I think that's good analysis, Cyprus, very helpful, and it speaks to what we think the arbitrage opportunity is with what we're doing in terms of what it costs us to discover a pound of uranium, and we've got a very good understanding of what our discovery costs are. We believe that the value of finding a pound will show up in our share price over time, and so we've invested ahead of that valuation arriving in our share price, and that is the arbitrage for investors. And when we sort of look to apply our funds, that's what we're thinking about. And the good wildcatting, we got a very good idea about where those extra pounds are and what our yield on investment will be over time. I think on the M&A side, I mean, the big guys, Rio, they've got assets all around us in the Great Divide Basin, including the Sweetwater Mill plant, and they've got multi-million-pound deposits to the north and south of our Green Mountain project. They're not really doing anything in the market, and it'll be interesting to see whether they want to assume that the way they come back in is probably through acquisition, and maybe a significant acquisition. And there are some large development assets in Canada, NextGen, for instance, Fission. So it would sort of be more the scale that those companies would look for. We know BHP's in uranium. It's one of the largest producers in the world out of Olympic Dam as a byproduct in Australia. But it's hard to know where they are at, but they've started to accept uranium explorers into their Explore program, into their venturing program, where they give companies $500,000 and expertise and alignment with BHP. So they are serious about uranium to the extent that they see the opportunity. It's significant for them. It's not tiny in terms of their current income, but it is a byproduct from Olympic Dam. They're not going to turn the switch on Olympic Dam just off the back of the uranium price, because it's the copper is probably the major component there, but it is conceivable they'd come into the market. The other thing that's happening is you've seen Exxon get into the lithium game and various other companies, strategic investors in the sector or strategic players other than. We know the oil companies were very involved in uranium in the US back in the day, and we can see that they understand the property. They've drilled. Wyoming is covered in oil and gas wells, literally. It's the second largest energy state in the US after Texas, and most of those holes were drilled by oil companies when they were diversifying back in the last energy shock. So we could see oil companies come in and make strategic acquisitions to get a cornerstone back in the industry. And then you've got the overseas, as I said, Korea, China, Japan, France, that acquiring access to pounds to drive these policy settings for tripling nuclear power. So, it's conceivable that they will come in on an investment basis, possibly not an acquisition. If you're a Japanese conglomerate, part of the energy system for supplying electricity in Japan, maybe it would be an outright acquisition. It certainly has been with China. So, and I guess Orano, would do that in conjunction with the French government. So there are plenty of, I guess, interested buyers in assets, and we look at it on a more localized basis. Look at the producers around us and say, well, who would be interested in our asset? And we don't have to look very far away. We're within 10 or 15 miles of both UR Energy and Cameco. We've got Energy Fuels 40 miles up the road. We've got UEC, 30 or 40 miles up the road. Encore Energy, are 100 miles away, and all of those, they're all trucking distance for resin beads. So there's no reason why our asset in particular to some of our neighbours at the right point, if we've got the right story around that asset, if we've got the right empirical understanding of it and the economic case around it. So, I think even at the local level for us, the same story applies. There are those with a strategic and interest in getting access to pounds, and I think M&A definitely going to be part of the scene going forward.
Yeah.
And part of the reason for that is skills and expertise. Having the people to actually take an asset through to development and production, and the best teams will hopefully end up with the best assets, and then we have a healthy industry as a result. I think it is a feature going forward for sure. It's got to be.
All right. No, excellent. No, thanks for your thoughts, Cypress and Bruce. Given what we've discussed today, how can investors leverage that, and movements in the uranium spot price and the structural shifts in the industry that we sort of talked about? How can they, obviously Cypress thinks that there's room in the spot price, there's headroom in the spot price for it to run, but how can investors sort of invest in the medium and the long term? Maybe even share how have you structured your portfolios? Obviously, Bruce, you've got a lot of skin in the game at GTI, so your portfolio might be a bit skewed, but yeah, how would you invest, or how have you structured your portfolios?
Yeah, so maybe if I talk about the way I've approached it, Cypress, and then you can give us more of a sort of an analyst's view, and hopefully they won't be hugely different. I think, as you say, Tim, I mean, my portfolio is naturally a bit skewed. I'm a bit deeper into the exploration space than perhaps I would be if I was coming at this from a portfolio approach. Although our exploration on the risk end of the spectrum is not, it's not a greenfields play. It's based on some very solid insights and access to data and access to people who understand where we're exploring and what we're exploring for and how it gets developed. So I think the risk is managed from that point of view, but there are a bunch of things you can't manage out, and then one is market risk, and so you go against that lens. And so where I have my investment is I do have a bit of money in a couple of ETFs. I think that gives you a broad exposure to a basket of companies, and if you get your stock picking wrong, it means you don't miss out on what seems like a no-brainer sector opportunity. and okay, your returns are kind of normalized a bit. You've got to expect that you may not get the outperformance you might get if you happen to pick a unicorn, but it's a good way to invest in it, and you don't have to kind of fret over the details of every announcement of every company. So I think that's a great way to invest. A lot of the ETFs, some of the ETFs actually have the Sprott Physical Uranium Trust embedded into the ETF. They have a significant position. So you're going to get a lot of Cameco. You're going to get maybe some Kazatomprom. You're going to get SPUT, get URA. URA and Uranium will probably both have those. URNJ will probably not have the bigger names because it's more explorer focused, but you'll get the big explorers, the ISO Energies, and the next gens and the fissions in the URNJ. But you also get those in the other ETFs anyway, usually because they're significant players in the index. So I think the ETF's a good way to go. Some people like a direct investment in SPUT because they want to be anchored in the physical and they want the leverage to that. Personally, I'm not so worried about that, but I've certainly wouldn't be advising against it. It's a little bit more difficult for me to invest in from here in Australia. I mean, because I'm taking currency risk in some cases, as well as the direct investment risk, and that's why if there's a locally listed ETF, that kind of helps me not to have to worry about that too much. It's going to be what it's going to be, and I don't have decisions to make around that. But I do like there are some I've been an investor in Boss, for instance, for a long time, and from way back, I always believed that story, and I thought they got it at the right price, and I think the people are really good. So I've always had that, and Deep Yellow and Paladin, I got a bit of those. They're more Australian-oriented stories. I've got a bit of Peninsula, but I'm not advising anybody to do that. But it's a local Wyoming story that we know quite a bit about, and it's ASX listed. So it's that it is kind of, I think it's been an essential part of our portfolio, my portfolio personally, because I want to follow that story closely. I want to really understand every little detail of what's going on there. I know the Wayne Harley personally, had met him a couple of times. So, all those things are factors in terms of my decision about what to invest in. Explorer-wise, pure explorers, look, I think there's a couple in Canada that I think are, they've got awesome deposits in the Athabasca, completely different style of deposits to what we've got in the shallow sandstone in Wyoming, but massive projects in like NextGen, big potential in fission. They're the sort of things where I think they're more the unicorn plays. You might have missed the early part of the unicorn on those, but I don't think it means over. And if there are acquisitions made by majors and there's takeovers, they're certainly not going to be getting them at a discount. So you do add that in on top in terms of the potential for the future. So that's kind of where my portfolio's at. And it's a mix of I've got some time to put into it, but I don't want to have beta, and it helps that I'm in the sector and I see all the announcements because I do take notice of everything. But I really, and that's part of the reason I'm in the ETF is because it's just such an efficient way from a time point of view and a risk point of view to manage exposure to the sector. So I hope that helps in terms of where I'm at, and I'm sure Cyprus will tell me I'm doing a couple of things wrong.
No, I wouldn't say that, Bruce. Each to its own right. Every investors have their own strategy and approach. I think there's no right, no wrong. Kind of similar. I would position my uranium portfolio as 40% in uranium ETFs. I think the Sprott Physical Uranium is a very good ETF to own because like I said, there's we never know what the spot price will be, and it could go up to 6 times of its break-even price. So the Sprott Physical Uranium Trust is the best way to get you exposed to the spot price. Or you could invest in Allocate. They are a company that buys and holds inventory of physical uranium. So I think they're sitting at 20 million pounds right now. At $100, I think that's 20 billion. So I think the company is just trading slightly below that value. So if spot price continues to rise, I think they will benefit as well. I'll put another 40% in producers, large producers. That will give me, the exposure to, any margin upside. But of course, you have to bear the risk of selecting individual stocks, and like Bruce said, you have to keep updated to what they are doing, and you can never know if there's any supply chain issues like what Kazatomprom or even chemical experience that kind of upset your expectation. So I would still emphasize 40% in uranium ETF to really give you a peace of mind, comfort, and it helps you to filter off any bad companies or any unexpected scenarios that you might experience in single stocks. And then the last 20% of my portfolio will be in explorers, because I believe the M&A game will pick up. But as you guys know, higher risk, higher returns. So 20%, it's kind of the sweet spot for me.
Yeah, I think that's sound analysis. I think it is interesting that the ETFs in the uranium sector, URA and uranium, are quite big drivers of activity, because there isn't much in the sector. Usually $1 billion total listed value as a sector. It may have gone up slightly in the last bit. I don't know what the latest number is, but by global standards, in terms of markets, commodities, it's not huge. It's small. And if you think that a lot of the major fund money needs, daily liquidity of, say $50 million, some of these stocks to that kind of volume. Now, as the price in the sector lifts, obviously that helps, and as more people come into the sector, that helps. So you kind of get a leverage to all that happening in the future if you believe the sector's going to get, bigger on that basis. So, but if you go down below Cameco, URA, uranium, spot, they're the investment grade vehicles, really. I mean, below that, the liquidity, even out of the largest company in the US, which is UEC, it's maybe, I don't know what the latest is, a couple of $1 billion or 2.5, whatever it is. That's doubled in the last. You can see that, getting a daily liquidity out of those vehicles can be challenging. Some of them aren't highly traded. UEC, I think, has a lot of liquidity in it. But if you go below that, then it's kind of hard for serious money, big money, to come into these vehicles. And that's why they're going to come into the ETFs and into spot, and particularly into the ETFs. And I know that John Campaglia has been doing, from Sprott, has been doing a global tour, and he's spoken to literally hundreds of people in the professional finance industry, and no doubt he's been in Singapore and Hong Kong and all the rest over the last recent period, just to explain what they believe the drivers in the sector vehicles. So that, and we think that the more money that comes into those guys, obviously they buy the list, they buy the index that's that they buy on, and that drives a lot of liquidity. It also drove a fair bit of selling at the end of the last period, where they were rebalancing and having to sell down the likes of Cameco, so that rebalance and reweigh their portfolio to stay in line with the index. So it does generate some volatility in the stocks, and that's just something to be aware of. It's a feature of the industry. That's why you see, these ups and downs and this volatility is because the sector is small, and all of the decent companies that kind of tick those scale metrics are in the ETF, and then they're subject to the machinations of the ETF trading. And if the ETF gets a lot of inflows, then those stocks get bought, and they kind of lift the sector that way. And then hopefully everybody else that's in the sector that's got a good story will also get bought. But it does take a while to catch up, because the guy at the ETF, he's just buying based on the index, and he doesn't have to go out and do analysis on the company. It's already done for him. Whereas if you want to go do direct investment in a company like ours, you have to come and find out, or we have to find you and find out. And so there's a lag, whole sector goes up, and then it's going to take a while for the individual stocks that aren't in the ETF, to actually catch up valuation wise. And I think that's a process you'll see. So the wonderful thing for an investor is that that's an arbitrage opportunity. If you can see all the stocks that are in the ETF are going to go up, and then all of the other stocks, they may not be in the ETF, and because the ETF is based on the index, there are some really good stock picking opportunities and arbitrages there for those valuations to catch up in the future. And that's where I believe there's some value to be found.
Yeah. Thanks for sharing that, Bruce and Cyprus. Now, just as we sort of wrap up our webinar, just want to say big thank you to everyone who's held on all the way to the end. I know we've gone slightly over from when we'd originally planned, but maybe just a final note, Bruce and Cyprus, if people want to read more about uranium or want to find out more about GT Energy, what's the best way? What are some good resources that they can refer to?
Yeah, for GTI, obviously, they can reach out to me individually. Our website's pretty good. In general, I think there was some good sources. I think if you want to pay for a subscription to a service, then the Uranium Insider, Justin Huhn, is very good. And that's really for somebody, I think, who's involved in the industry, in stocks day to day, or maybe you just want 12 months of immersion to get up to speed with the sector. I would highly recommend it as an opportunity to learn and also they run a portfolio. So they talk about their portfolio. They're an investor. They're a fund manager as well as an industry. So very, very worthwhile. If you're on Twitter, just follow John Quakes, Quakes at Quakes99, and then you will see others to follow as well. Off the back of that, I mean, I could give you a list of sources on Twitter that are very useful but helpful. But at Quake, place to start. He's kind of professionally covered the industry for many years. And then, outside of that, the various conferences are very good. Spark does a really good one every year, and there's a uranium company, at least one uranium company, maybe two involved in that. So those are good source. But there are uranium conferences online. I mean, Red Cloud Securities run a really good uranium focused conference. They're probably one of the biggest, if not the biggest, in North America. You've got Bloor Street Capital, BLOOR Street Capital. They do a bit. The Crux Investor, they kind of started out as a uranium. They've got they do really good interviews and analytical kind of interviews, so they're a really good source as well. Look, there are a lot, and I think maybe that's something that I guess, Cyprus, we can follow up with an email with a list of a few things so that people can kind of have a look at those things and decide if they're worthwhile. But certainly they're the sorts of things that I use. There are numerous other things, but those are some obvious ones which are easy to access.
Yep. I think I share a couple of same sources from you, Bruce. Of course, I think the best way is to speak to Bruce. He can give you a lot of information about the uranium sector. Uranium Insider is very helpful. It's a paid source. They go very in depth and they kind of have content almost every day. So that's very useful. Cruise Investor, it's a good YouTube channel to learn from. They invite a lot of CEOs and industry experts on the show to interview them. So that gives you insights with things you wouldn't really usually hear from the textbook or educational videos. And I would think speaking to Tribeca would be good. If you guys have.
Sorry. Yeah. That's one I missed. I think Guy Kelleher at Tribeca's been very successful with his, and he invests, on behalf of a significant pool of investors and family offices. So, he if you can find his interviews out there on, he's well worth listening to as well. Absolutely, as is John Campaglia from Sprott. You know, if you think about talking heads in the industry, Sprott have been very, very successful with capturing both the physical uranium trust as well as owning URNM, the ETF. And so every dollar that where the spot price is going up helps those ETF stocks. And so they've managed to capture the leverage to the upside in the uranium market in quite a spectacular fashion. So I think that the physical uranium trust was $600 million or thereabouts when he took it over. It's about $6 billion now. So, you know, they've got sort of 60 or 70 invested into that closed-end fund. So they're very smart people and very, very well worth listening to as well if you want to take the time. And finally, the last thing I'll say is Cameco's quarterly investor calls, I think, are kind of compulsory fodder for anybody who wants to understand the sector. Cameco's the largest integrated player in the industry, and you know, with their investment in Westinghouse, and they talk, you know, they do talk about various themes and give a good commentary on those quarterly calls. So Grant Isaacs, the CFO, you know, he often attends conferences, those things, and he's, you know, look, they talk. They love their contracting strategy, whereas UEC's Amir Adnani is going to sell naked and he's going to put it all into the spot market. And I don't think they respect that approach, maybe. But anyway, each to his own. I think Cameco is definitely worth listening to, as is Amir Adnani at UEC. You know, his interviews are always worth a listen. He's been a long time in the industry and been very, very successful at consolidating and building America's largest uranium company from virtually nothing. So you know, once again, well worth a listen.
Yep.
Well, with that, we're going to draw our webinar to an end. Thank you, Bruce. Thank you, Cypress, again for making the time to speak to us and have this discussion today. Thanks again, everybody, for jumping on, and we'll see you in the next one.
Yeah. Thanks, everyone,
thanks, Tim.
for popping on.
Yeah, thanks, Cypress. Thanks everyone for persevering and hanging on if you did. Yep.